Hello, everyone, and welcome to today's webinar. My name is Anna Sood, and I'm the Director of Product Management at Alessa and today's moderator. I hope everyone is doing well, and we thank you for taking the time to join today's presentation. So while OFAC sanction regulations seem relatively straightforward, establishing the appropriate policy and practices to comply with them can be challenging. So in today's webinar, we're going to tackle how a sanctions compliance program should be structured, some of the screening practices, what to do if you have an OFAC match, how to comply with the 50% rule, and finally, how to use enforcement actions to evaluate your own practices. Our presenter today is Laurie Kelly. Laurie has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as a Director of Compliance for CoBank ACB, a $145 billion farm credit system institution, where she developed and managed the bank's AML, fraud, and economic sanction compliance programs. She holds CAMS designation and CAMS audit specialization. She also helped found the ACAMS Colorado chapter, where she served as its executive board chair and programs director. So with that, I would like to hand the presentation over to Laurie.
Well, hi, everyone, and thanks so much for joining the webinar today. We're going to dive into OFAC, or the Office of Foreign Assets Control. And we'll start with some basics, just like what is OFAC, what are economic sanctions, and of course the OFAC SDN list. Then we'll talk about an OFAC compliance program and risk assessment. And next, we'll do some deep dives into a number of topics. We'll talk about name screening processes and issues with specific types of names. And then we'll go over OFAC licensing, as well as the process to report OFAC matches and blocked assets. We'll also go into this perplexing 50% rule you may have heard about. And finally, we'll look at OFAC civil penalties from a little different perspective, and then we'll wrap it up and take your questions. But before we move on, let's take care of one more bit of housekeeping, and that is just be aware that my presentation today is meant to help you understand the subject, but I'm not a lawyer, so don't take anything I say as legal advice. Okay, now that we've got that out of the way, let's get started. I'm sure many of you participating today are very familiar with the Office of Foreign Assets Control, or better known as OFAC. But here's just a little background to lay the foundation for what we're covering today. Now, OFAC is a financial intelligence and enforcement agency of the U.S. Treasury Department. Its job is to administer and enforce economic and trade sanctions that support U.S. national security and foreign policy objectives. Now, OFAC operates under the Treasury's Office of Terrorism and Financial Intelligence, and it's primarily staffed by intelligence officers and attorneys. OFAC, as we know it today, was established back in 1950 when China entered the Korean War. And President Give 'em Hell Harry Truman at that point declared a national emergency and blocked all Chinese and North Korean assets subject to U.S. control. So just what are economic and trade sanctions? Well, they're basically a way for one country who doesn't like what another country or group or person is doing to coerce, deter, punish, or shame them into changing their behavior. In today's world, that includes things like terrorism, narcotics trafficking, human rights abuses, cybercrime, unrestricted nuclear weapons, and military aggression, along with many others. They're called economic and trade sanctions because they're meant to block the target's access to the U.S. financial system and markets. And they can take the form of trade restrictions or travel bans or freezing the target's assets in the U.S. And now, sanctions are a tool for responding to foreign policy issues, and the United States uses economic sanctions more than any other country. We have 36 sanctions programs. Now, some target specific countries, while others are aimed at curbing activities like terrorism, cybercrime, and drug trafficking. The United Nations is the second largest sanctioning body, followed by the European Union. So just how do U.S. sanctions come into existence? Well, before we talk about the process, let's first understand the underlying legal powers that allow them. There are two sets of powers. One is Congress, which can pass legislation imposing new sanctions or modify existing ones. But the more common way that sanctions come about is through a presidential executive order. Because getting a law through both branches of Congress can take a while, a law was passed in 1977 called the International Emergency Economic Powers Act, more commonly known as IEEPA. And IEEPA gives the president the power to declare a national emergency in response to a, quote, unusual and extraordinary foreign threat. Now, it gives the president special powers to regulate commerce. Remember, economic and trade sanctions with regard to that threat. The thing about sanctions imposed by executive order is that they allow a U.S. president to exercise power unilaterally and often very quickly and without input from Congress. But there is a process for sanctions through executive orders. So it all starts with some kind of foreign crisis, like, say, Russia's invasion of Crimea. The National Security Council starts having discussions with federal agencies, and they start to design the scope and make a list of the initial sanctioned targets. Then they submit a recommendation to the president and the cabinet, and if everybody's in agreement, then it's passed on to OFAC to draft a sanctions executive order. Now, OFAC will consult with several federal agencies like the Department of State, Justice, and maybe some of its agencies, perhaps the DEA or Homeland Security, as well as the Commerce Department. Now, the Commerce Department is important because one of its divisions, the Bureau of Industry and Security, or BIS, enforces the Export Administration Act. Now, remember, these are economic and trade sanctions, so BIS and OFAC need to be in lockstep, really. And then the draft executive order goes back through the State Department, the DOJ, and White House attorneys to make sure everything's legal and within the scope of IEEPA. And after all that work, the NSC packages up the executive order, the list of initial targets, and the formal policy decision and presents it to the president for his signature, while OFAC publishes the regulations in the Federal Register. Now, as I mentioned, OFAC administers the 36 existing U.S. sanctions programs. And we generally refer to sanctions as either comprehensive or targeted. Comprehensive sanctions usually prohibit all commercial activity with an entire country, like North Korea or Cuba. But often the sanctions are targeting just key players within a country's government and not the country itself. But the names of the sanction programs often refer to the name of the country, like Venezuela, or Libya, or Nicaragua, even though the sanctions aren't all-encompassing on those countries. But right now, the most comprehensive sanctions programs are on Cuba, North Korea, Iran, and Syria. North Korea sanctions are pretty comprehensive, as are those on Syria, but Iran's primarily now target the country's government, its financial sector, and its aviation and petroleum industries. Now, targeted sanctions, on the other hand, are just what they sound like. These sanctions target a type of activity like terrorism, international narcotics trafficking, cybercrime, or even foreign interference in a U.S. election. Now, traditionally, sanctions prohibit only the imposing country's citizens from doing business with a targeted party. But in the U.S., we've also imposed extraterritorial sanctions, which are also probably more commonly called secondary sanctions. Now, these try to restrict the economic activities of other countries, governments, businesses, and individuals. In other words, you comply with our sanctions or we'll sanction you too. And as you can imagine, many countries consider these extraterritorial sanctions to be a violation of international law. And who knows, maybe they could be right. Now let's talk more about the OFAC Specially Designated Nationals and Blocked Persons List, or the SDN list. Now, OFAC publishes and maintains this list of all parties that are targets of U.S. economic sanctions, or as we call them, SDNs, Specially Designated Nationals. The SDN's assets under U.S. control must be blocked. Now, a better word would be frozen. So think of bank accounts, real estate, businesses, and other types of valuable things. As well, all U.S. persons, including U.S. businesses and their foreign subsidiaries, wherever located, as well as foreign financial institutions with U.S. offices or subsidiaries, are forbidden from transacting with an SDN. As of about a month ago, there were over 20,400 names on the SDN list. Now, this includes primary names and then alternate names or aliases for these parties. The SDN list also includes the names or identifiers of 277 aircraft and 403 ships. The ships are mostly associated with Iran, Cuba, and North Korea. And the aircraft are almost all tied to Iran. Remember, we're sanctioning their aviation sector. And there are a few from Venezuela. Now, something I say a lot when explaining OFAC sanctions and regulations is the F in OFAC stands for foreign. So that means no domestic terrorists, no domestic narcotics traffickers, and so forth. But there are a handful of U.S. parties on the SDN list, and they're on it because of their association with a foreign sanctioned party or activity. So here they are as of mid-February. 12 individuals, 3 with U.S. dual citizenship or permanent resident status, and 9 foreign individuals who have U.S. addresses. 45 U.S. companies, but all of them inactive shell companies, mostly set up by narcotics traffickers. 7 U.S.-based charities, all of which are alleged to have acted as conduits for terrorist financing. For example, in 2001, the Holy Land Foundation, which was the largest Muslim charity in the U.S., was targeted for providing support to Hamas. The charity and 5 people who worked with it were actually ultimately found guilty of 36 counts related to illegally transferring millions of dollars to Hamas. There are also 4 foreign-based businesses that have a U.S. location or address, 1 aircraft that's registered in the U.S., and a criminal gang that got its start in L.A. but is now considered a transnational criminal organization. Okay, now we've covered the basics of the Office of Foreign Assets Control, what are sanctions, and the SDN list. Now let's talk about the OFAC Compliance Program. In May of 2019, OFAC published guidance describing what it considers to be the core elements of an effective OFAC compliance program. And what you see here are those elements. For many of you, this might look kind of familiar. Looks a lot like the pillars of an AML program, minus the customer due diligence part, right? Well, every U.S. financial institution should have a formal OFAC compliance program in place, as really should businesses that have dealings with foreign parties. But remember, this is guidance only. There's no regulatory mandate to follow this structure or even to have a compliance program at all. But OFAC does not so subtly emphasize that the lack of a compliance program can be a root cause of sanctions violations, as well as an aggravating factor when they're deciding on penalties. Now, if you're familiar with the pillars of an AML program, most of these elements are exactly like those: the internal controls, the independent review, and staff training. What's interesting here, though, is the element about management commitment. What does that mean? Well, it means things like appointing dedicated compliance personnel, or providing compliance teams with adequate resources and support, and generally promoting a culture of compliance. Now let's talk a bit more about the risk assessment element. Now, to me, OFAC is the epitome of what we like to call risk-based compliance. And this is because every single entity is going to have its own unique level of risk of having dealings with sanctioned parties or countries. And I can't emphasize enough how important it is to have a thorough written OFAC risk assessment that's reviewed and updated regularly, because sanctions programs are constantly changing as political and economic events occur around the world. Now, here are some of the most common areas where a financial institution would have a higher OFAC risk exposure. At my bank, our biggest risk came from export financing. We had to make sure that no party to an export transaction, no bank, no ship, and no country involved in that transaction were OFAC sanctioned. And our second biggest risk area was international wire transfers. Our customers sent and received a huge volume of foreign wires every day, and these were primarily tied to imports and exports. And these payments often originated from what are considered, quote, high OFAC risk countries in the Middle East, Eastern Europe, and Asia. Now we're going to go into our deep dive section. And this section of the presentation is where we'll get into some of the more granular issues around OFAC compliance. Now, your OFAC risk assessment should direct your risk-based policies and procedures, just like an AML risk assessment. But this is a perfect segue into this first deep dive on OFAC screening practices. First of all, remember that there are no regulations that require how, what, or when to screen, or even whether to screen at all. It's all based on your risk assessment and your level of risk tolerance. Now, I'm going to touch on first some of the more commonly recommended best practices for screening, and then talk about some nuances of automated screening processes. Now, let's start with these best practices. And when you think about screening, we're usually really dealing with two main areas, payments and counterparties. So first, let's talk about payments. Automated OFAC screening of electronic payments is a best practice. So thinking about it, what are the highest risk payment types? Remember, the F in OFAC stands for foreign. So foreign transactions are going to pose a higher potential OFAC risk than domestic ones. And most of these are through some type of electronic funds transfer, wires most likely, or international ACH. Now, should you try to distinguish between domestic and cross-border payments with OFAC screening? Well, with wire transfers, it's pretty much a cost benefit and a risk trade-off, meaning it's probably way more efficient and less risky to just screen every single wire transfer rather than try to systematically distinguish between domestic and foreign, which can be a gray area. Now, ACH, though, is a little different. It is a common practice in the U.S., and in fact, OFAC has even opined that domestic ACH transactions do not need to be screened. Now, this is based on the assumption that each bank will have done the due diligence on its own customer before a transaction is entered into the ACH network. But because international ACH, or IATs as they're called, either start or end in a foreign country, you can't make that same assumption. Fortunately, though, IATs are clearly identifiable based on codes, so they're easy to segregate electronically and therefore OFAC screen. And import-export finance and trade services, as I was just talking about before, pose a significant OFAC risk because they're foreign-based, and many OFAC sanctions programs are heavily focused on commerce restrictions. That's why they call them trade sanctions. So the underlying details in a trade finance transaction should also be OFAC screened. Not only are we looking for sanctioned parties or countries, we're also looking for any sanctioned vessel names. So with transactions, make sure that you're screening every field on your EFTs, the originator, the beneficiary, their addresses, all the bank names and addresses. If you have import or export letters of credit, which typically come through SWIFT messages, the entire document should be screened. Okay, now let's move on to counterparties. First is customers. Now, OFAC screening of a new customer name and now the name of any beneficial owner of a legal entity customer is a commonly accepted best practice as part of the customer due diligence process. What's interesting is that the CIP, or Customer Identity Verification rules, state that a financial institution should, quote, determine whether a customer, and now as well a beneficial owner, appears on any list of suspected terrorist or terrorist organizations. Now, they don't tell us which list this is, so the only one I know of that's public information is the OFAC SDN list. But as we know, OFAC has more than just terrorist names on it. But get this. I found this text in a FinCEN guidance document from January of 2004 titled FAQs on the Final CIP Rule. Question: has a list of known or suspected terrorists or terrorist organizations been designated for purposes of the CIP rule? Answer: no such list has been designated to date. Banks will be contacted by their functional regulators when a list is issued. As of the time of publication, lists published by OFAC have not been designated as lists for purposes of the CIP rule. Of course, banks are separately obligated to check these lists in accordance with OFAC's regulations. Wait, what? What do you mean there's no list? And apparently the folks at FinCEN aren't too well versed in OFAC regulations because there are none that require banks to check these lists. So despite all this confusion, it is a best practice to OFAC screen your new customer names and any beneficial owners' names as part of customer due diligence to mitigate your OFAC risk. It's also a best practice to perform a scan of your entire existing customer database on a regular basis, as well as anytime there's an OFAC SDN list update, which can happen pretty frequently, sometimes multiple times in 1 week. Now, failing to do this has gotten some financial institutions into some trouble over the years. In one case, Discover Card found out, or discovered, that they'd been maintaining a personal credit card account for someone on the narcotics trafficking kingpin sanctions list for almost 2 years. Now, we'll talk about OFAC violations and penalties a little later, but I wanted to just bring this one up because it's a great example. And when it comes to other types of counterparties, this is where your risk assessment really comes into play. Now, these could include vendors, employees, and also foreign correspondent banks or participant banks if you're a lender that's involved in the capital markets. Once again, remember our mantra, the F in OFAC stands for foreign. So if you don't do business with any non-US vendors, there's virtually no OFAC risk. Same for your employees. If they're all US based or they have authorization to work in the US, then there's not much value in screening their names. If you want to be super careful, maybe once or twice a year, but again, this is all based on your institution's risk tolerance. Now, I should mention foreign bank counterparties are often treated like customers. Lots of due diligence up front, which should include OFAC screening. So it's a recommended best practice that you treat these entity names just like you would customer names, but with a higher level of risk because of their foreign nature. Now let's get into a couple of nuances with automated OFAC screening pertaining to various party name issues. And the first of these is dealing with something called a weak alias. Now, weak aliases are nicknames or nom de guerre and extremely common acronyms. And OFAC says they give us these aliases because based on their info, the person may informally go by one or more of these names. And OFAC thinks these might be useful to us for identification purposes. Now, why these would be of use to anyone outside of law enforcement, I really don't know. But OFAC does realize that these are going to generate a lot of false matches. So they've been kind enough to specifically distinguish them from other aliases by designating them as weak. Now, something else to keep in mind is that OFAC does not expect that we would screen transactions or customer names for these weak aliases. So how do you tell if an alias is a weak one? Well, in electronic SDN records, like this one here, which I pulled from the OFAC website, SDN search tool, you can usually see the legitimate aliases versus the weak ones. But if you're ever looking at a text file or a PDF version of the SDN list, weak aliases are actually in double quotes. Like in this example where Hassan the Old and a few others are all weak aliases for this party. The second issue that can cause a lot of problems with automated screening is non-Western name parsing. In other words, how in certain cultures it can be more challenging to break down or parse a person's name between first, middle, and last name or surname. Let's look at a couple of examples of this. First, in Spanish cultures, a person can have a lengthy surname. Very commonly, there are two last names where the first one is the person's father's last name and the second one is their mother's maiden name, because women often don't give up their last name when they get married. So in the case of our U.S. Senator Alexandria Ocasio-Cortez, her last name is Ocasio-Cortez. This reflects her father's last name, Ocasio, and her mother's maiden name, Cortez. She's actually added a hyphen to make her surname very clear. In Asian cultures, however, the person's last name goes first, followed by their first name. So Chan Kong Sang would be parsed as first name Kong Sang, last name Chan. And by the way, this happens to be the original name of a famous actor, Jackie Chan. Now, Arabic names are even more complicated. Let's take the name of a man called Saleh ibn Tariq ibn al-Khalid al-Fulan. And if I'm mispronouncing any of these names, please forgive me. So Saleh is his personal name and the one that his family and his friends would call him. Ibn translates as son of, so Tariq is Saleh's father's name. Ibn Khalid means Tariq is the son of Khalid, making Khalid the grandfather of Saleh. And Al-Fulan would be Saleh's family name. So his full name translates to Saleh, son of Tariq, son of Khalid, of the family of Al-Fulan. So how do we separate these SDN names into their parts for more accurate screening? Well, software developers worked on this challenge for many years, but in 2015, OFAC put out a new sanctions list file format known as XSD, or Advanced Sanctions Data Model. It's got a lot of capabilities, especially when it comes to both identifying weak aliases and name parsing. With respect to name parsing, it gives specific labels for different name parts that go beyond just the standard last name, first name. And these labels allow for correct parsing of names based on the rules of a specific culture or language. And only in the XML and this latest XSD formats are the aliases identified as weak or strong. Now, flat and delimited files formats don't include this detail. So if your current OFAC screening software can't exclude the weak aliases, or it can't properly parse non-Western names, it might be because it can't accept XML or the more advanced XSD file format, something that you'd want to check into. Now let's move on to another deep dive topic, OFAC licenses. As we know, sanctions prohibit all dealings with a targeted party, faction, government, or country. But especially when it comes to these country sanctions, the U.S. doesn't want to, A, prohibit things like humanitarian assistance, or B, have a detrimental impact on our own economy. A license is an authorization from OFAC to engage in a transaction or an activity that otherwise would be prohibited. There are two types of licenses, specific and general. A specific license is, as the name implies, an authorization for a U.S. party to do some specific activity that would otherwise be prohibited by sanctions. You have to apply to OFAC for a specific license before you engage in that activity. So some examples of specific license would be required, including traveling to Cuba and exporting agricultural commodities to Iran or Sudan. A general license, on the other hand, is sort of a blanket exception to the sanctions for certain things. A general license authorizes a particular type of transaction without the need to apply for a license. So, for example, exports of ag products are permitted to Syria, and non-governmental organizations can conduct humanitarian projects in North Korea, both under general licenses. So where do you find information about licensing? Well, OFAC lists every general license and describes it on their website page for each individual sanctions program. And so if there's no general license for something, then it's prohibited unless OFAC authorizes it through a specific license. Now let's move on to our next deep dive, OFAC reporting. Okay, let's say your screening system flags a match to a sanctioned party on a wire transfer. Your first step, of course, is to evaluate whether it's valid or a false positive. And honestly, it's a safe bet that 95% or more of all system-generated matches are false positives. And you can take steps within your software settings and algorithms to help mitigate that. If you think it might be a valid match, you can either reach out directly to OFAC through their special online form for in-process wires. But they're going to ask you the same questions that you could ask yourself without contacting them. And these are, first of all, is there a party address and does it match to the sanctioned party record? How about just the country? Is there any other identification or details that would point to this being a valid match? Have you asked your customer about the purpose of the transaction and what clues does that give you? And could the transaction potentially be exempt from OFAC sanctions based on a general or a specific license? Again, you'd want to ask your customer. So now let's say you've determined that you do have a valid match and there's no OFAC licensing involved. So what's the next step? Well, when we're dealing with a transaction, you have to determine if you should block or reject it. Either way, you must report it to OFAC within 10 days of the date you actually decide to block or reject the transaction. Blocking essentially means holding on to the funds and freezing them. And then only OFAC can decide what happens to those funds. Rejecting, on the other hand, is like it sounds, refusing to process a transaction. So when do you block and when do you reject? Well, the answer lies in whether there's a blockable interest in the transaction, meaning money. So let's look at some examples of each one. Let's say first of all, you flag an OFAC match on an outgoing wire transfer from your customer to a beneficiary in Russia called Internet Research Agency, LLC. Now, this company is an SDN under the cybercrime sanctions. Because you have these funds in hand and they were destined for the benefit of a sanctioned party, there is a blockable interest, which means you must block the transaction and freeze the funds by moving them to a separate account. And then, as I said, OFAC will ultimately decide what happens to the money. Now, let's say you flag an OFAC match on a commercial payment that's destined for the account of, say, KBX Import-Export in North Korea, whose account is with a bank in South Korea. Neither KBX, the beneficiary, or its bank is a sanctioned party on the SDN list. So there's no blockable interest in this transaction. However, under the sanctions regulations, all trade with North Korea is prohibited. So as a bank, processing this payment would make you be a facilitator of trade with North Korea. So you should therefore reject it. And of course, report it to OFAC. Now, one thing about OFAC reporting is that unlike suspicious activity reports, there's no secrecy or confidentiality surrounding OFAC blocked or rejected transactions, or that they've been reported to OFAC. It is perfectly acceptable to tell your customer that you've done so and why. And you probably should, since they'll be expecting their transaction to go through. They aren't going to be too thrilled about this, but that's going to be their problem. So how do you report a blocked or rejected transaction to OFAC? Well, the easiest way is online. OFAC has a system called ORS, which I think probably stands for OFAC Reporting System, where you can file a report electronically by filling out an online form. Now, I will say, to use this system, you have to pre-register and get set up on it beforehand, kind of like the BSA SAR filing system. But you can also just fill out an electronic form and email it to OFAC. And remember that if you block and freeze funds, they have to be segregated. And this means put into an interest-bearing account, and only OFAC can authorize what to do with it. And then every year, you must file an annual report of blocked property. The effective date of the report is June 30th, and you have to file the report by September 30th. And be prepared to provide quite a bit of detail about every entry. So now let's move on to the next deep dive, this infamous 50% rule. Now, we could do an entire webinar on this topic, and maybe we will, but I'll try to be concise, and you can do some more research on your own. There is a lot of information about this out there. So here's the summation in the regulation that's known as the 50% rule. Any entity owned in the aggregate, directly or indirectly, 50% or more by one or more blocked persons, this would be SDNs, is itself considered to be a blocked person. The property of such an entity is blocked regardless of whether that entity itself is listed on the OFAC SDN list. And accordingly, a U.S. person may not engage in any transactions with such an entity unless authorized by OFAC. Now, a couple of points here before we get into some examples of this. First of all, this rule speaks only to ownership and not control. So you think about how with beneficial ownership, we look for parties that have ownership or control. And in this case, an entity that is controlled but not owned 50% or more by one or more SDNs is not considered automatically sanctioned per the 50% rule. There has to be actual ownership. Second, OFAC sanctions generally prohibit transactions involving an SDN, even if they're only acting on behalf of a non-blocked entity. So, for example, you can't enter into a contract that's signed by an SDN on behalf of some company. Now let's look at some examples to help you understand this. And I think when giving examples, it's a lot easier to follow if you use actual names instead of blocked person X and blocked entity Y and so forth. So I'm going to use an actual sanctioned party, David Guberman, and some fictitious company names. So example number one, David owns 50% of a company called Acme Corp. And Acme owns 50% of Altex Manufacturing. Now, neither of these companies are on the SDN list, but both of them are considered block parties under the 50% rule, because David directly owns 50% of Acme and indirectly owns 50% of Altex through his ownership of Acme. Now let's say instead that David owns 50% of Acme and 50% of Altex. So both of these companies are still block parties, just like before, now because they're both owned directly 50% or more by an SDN. But let's say each of these companies has a 25% ownership share in another company called Crypto Partners Limited. So is Crypto Partners considered a block party? Well, yes, because crypto is directly owned 50% by two entities that are owned 50% by David. Do you have a headache yet? Well, here's one more example. Let's say David owns a 15% share of GV Exports Limited, and his buddy, Vlad Venkov, also happens to own 40% of GV Exports. Is GV Exports considered blocked based on the 50% rule? Well, of course, you know I'm going to say yes, and the reason is that OFAC aggregates ownership by one or more SDNs when evaluating the block status of an entity. So 40% and 15% is 55%, right? But what if David and Vlad just own 15% of GV Exports? Well, in that case, it would not be considered a blocked party because their interests only add up to 30%. So you can see why this 50% rule is so horrendous. Now let's talk about some ways that you can mitigate the risks associated with the 50% rule. What makes this rule so hard is that OFAC will not publish SDN company ownership information. So that eliminates automatic screening and simple name matching. And clearly, the 50% rule now becomes an incentive to really dig down into the beneficial ownership of any legal entity customer. But when it comes to transactions, if there's nothing to trigger any kind of a match to a sanctioned party, you are not going to catch anything related to the 50% rule. I mean, you cannot research every single foreign transaction that your customers do. It's impossible. But where you do have more control is with customer due diligence. If you have commercial customers located in countries where there's a significant presence of individuals and entities on the SDN list, look very closely at their ownership structure. The same goes for a domestic company with a foreign parent or affiliates. And really, you should be doing this for any legal entity customer. Make sure your CDD process includes documenting their full ownership structure, which I know from experience can be pretty challenging at times. Along with this, be sure to capture your beneficial owner names electronically and make sure that they are being OFAC screened, just like your primary customer names, including that regular screening of the customer database and after every OFAC update. You should also try to partner with your correspondent institutions to develop a communication and information sharing process in the event that they may consider blocking or rejecting one of your transactions based on a 50% rule violation. They may know something you don't. And finally, invest as much as you can in technology that can provide public ownership data, negative news, and corporate structure information. Now, since the advent of the beneficial ownership rule, we are starting to see more and more data providers for this information, which is really helpful. Now, in this last deep dive, I want to emphasize and highlight a few points about OFAC civil penalties. I'm sure most of you have heard of the massive penalties OFAC has imposed over the last 15, 20 years in relation to sanctions violations. Something that's important to keep in mind, though, is that these penalties are always the result of deliberate and intentional acts, either to literally evade the sanctions altogether, or in the case of financial institutions, deliberately ignoring known weaknesses or processes in systems, sometimes for years. Here are just a few examples of these types of deliberate and intentional sanctions violations. First one, payment stripping. This is a deliberate process by banks of removing any reference to a U.S. sanctioned party from wire instructions so that the transaction can then make it through a U.S. bank without an OFAC hit. The foreign banks that were involved in this knew exactly what they were doing, and this process became a pretty profitable niche market for them in helping terrorist groups and narcotics traffickers and others who were sanctioned to get their money into the U.S. For more than 2 years, Bank of America knew about but ignored a huge problem with their OFAC screening systems, which prevented them from identifying matches to SDNs with multi-part last names. Just like we were talking about earlier, right? Name parsing. And over 4 years, they processed several hundred transactions for 6 designated narcotics traffickers. They also forgot to file annual block property reports for 5 different frozen accounts. Oops. And lastly, Zoltec companies, a U.S. company, they had continued to buy supply chemicals from a Belarus company after it became an OFAC SDN. Zoltec's executives knew this. They all knew it, and they deliberately continued to buy their stuff from this Belarus company. 26 purchases over the course of 3 years after the supplier was added to the SDN list. And they made these purchases through one of their subsidiaries in Hungary, so the payments never actually went through a U.S. bank. There's another interesting twist to, quote, deliberately having dealings with a known sanctioned party. And that's when you're forced into dealing with a sanctioned party as a result of extortion. Now, one example of this, it was Chiquita Brands International, the banana people. Now, they had a large banana growing operation in Colombia. And in 1997, Chiquita began making payments to 2 OFAC-designated terrorist groups in Colombia to keep these people from kidnapping or killing Chiquita employees. And over the next 8 years, they paid these 2 terrorist groups almost $2 million, knowing full well that they were sanctioned parties. Companies' senior executives knew about this, but they felt they had no choice. Ultimately, their lawyers convinced them to go to OFAC with this, and they wound up with a $25 million penalty. They also pulled all their operations out of Colombia. Another very real risk in today's world is ransomware payments. Now, ransomware is a type of computer virus that completely blocks access to everything on the computer, and then the criminals then extort a ransom payment from the victim to get their computer unlocked. Often the criminals will threaten to completely wipe the computer if the ransom isn't paid, or even publicly disclose the victim's data. They almost always require payment in digital currency to avoid banks and remain anonymous. If a victim intends to pay the ransom, and there's reason to believe the criminal may be a sanctioned party, OFAC should be contacted. In some cases, OFAC may grant a special license for you to make the payment, but they basically say, don't count on it. You will want to read OFAC's 2020 advisory on potential sanctions risks for facilitating ransomware payments. Now, this statement here on the right is an excerpt which shows just how serious they are about this. Now let's finish up with a wrap-up of our key points from today. First of all, remember that the OFAC SDN list is only meant to be a tool to help with compliance, and there are no regulations requiring any kind of screening against it. Next, don't forget our mantra, the F in OFAC stands for foreign. Document all elements of your OFAC compliance program in writing, especially the risk assessment, which, as it sounds like, many of you do. And be aware of these OFAC licenses, where to find information about them and how to handle them. Evaluate your CDD processes for legal entity customers to help try to mitigate these violations of the 50% rule. And recognize that OFAC penalties are almost always the result of deliberate and intentional acts, not some unintentional error. And finally, be aware of the growing threat of ransomware to both your institution and your customers, and the additional risks of sanctions violations in making payments to cyber criminals. Well, I want to thank you so much for participating today, and I hope this has been helpful to you.
So with that, I'd like to thank everyone and end today's presentation.